Hello everyone and welcome to Blue Chip Investing's YouTube channel. I'm your host Dave Reinhardt. And before we get started with this video, I ask that you would please like, share, and subscribe to our channel. By subscribing to our channel, you will be given access to premium content as it becomes available. You'll also be helping us out by increasing our numbers and helping us grow. We would really appreciate it if you hit that subscribe button below and also the like button. If you have any questions, feel free to comment on here or join our Facebook group at Blue Chip Investing on Facebook. So welcome everyone. Today we're going to be going over what is a vertical option. So basically, a vertical option is important because vertical option will be the most important type of option spread that you are going to learn. The reason that this option spread is so important is because this will become the single blueprint for more advanced option techniques as we progress. So as we go further in this segment and we learn how to do butterfly spreads, iron condors, back ratios, calendars, etc., everything's going to come back and tie into vertical options. So understanding vertical options is the most crucial part of option spreads that we can begin to learn. So we're going to go ahead and go over exactly what a vertical option is. We've already learned what a singular option is: buying a call, buying a put, selling a call, selling a put. So we're familiar with the lingo. We're familiar that one contract equals 100 shares, and we're familiar with expiration dates, strike prices, etc. If you're not sure of any of that, check out our old video that goes over some of the more basic option techniques and lingo that you will need to understand before moving forward with vertical options. Whoops. Okay, so what is a vertical option? A vertical option is very simple. It is a long option and a short option that share the same expiration date but different strike prices. So that means that we have an option that is bought, we have an option that is sold. They have the same expiration date, but they're going to have different strike prices on them. And we can either buy or sell vertical spreads. And in this video, we're going to go over both strategies. But actually, I lied when I said that. We're going to go over selling vertical options. And once you learn how to sell a vertical option, buying a vertical option will be the same thing. It's just we're going to flip it back. So let's go ahead and move forward. How do we sell a vertical spread? As I've mentioned in previous videos, we can sell options and collect a premium. I love selling options and collecting premium. I think it is a great way to help dollar cost average out of trades. It's a great way to get paid to trade your strategy to continue making money on a stock. So for easy math, let's assume that stock ABC is trading at $95 per share. And let's say that you're confident the stock is not going to go above 100. And the option is currently trading at $3. So if we're thinking about this, go ahead and let's stop right now and think about this. So we have a stock trading at 95. We're confident that the stock is not going to go above 100. And we can sell that $100 option and we can get $3 out of this option, which, as we know, is $300 in premium money. So we collect the $300 premium, and as long as the stock doesn't go above 100, we collect that whole $300 premium. So a lot of people are saying right now, well, why aren't we doing this more often? We should always be doing this. This is a surefire way to make a lot of money. Well, the problem with that is you are looking at a lot of undefined risk. Your risk is infinite because you have sold a naked call at this point. So the problem with what we just mentioned is that it is a very risky option trade because we have no shares of the underlying stock, and that means that we have undefined infinite risk. The stock could go to 115 and we'd be obligated to sell someone these shares that we originally promised them at 100, that would result in a $1,500 loss per contract. Even though we would still collect that $300 premium, that would be a $1,200 loss. So selling naked calls has infinite risk. It's undefined risk. That's why we don't do it. Naked calls are something that I would really urge you to stay away from. Covered calls are great, but whenever you have no shares of underlying stock and you're writing naked calls against them, it's too risky. Don't do it. Naked puts are a different story if you're looking to buy into a stock at a certain price anyway, but naked calls carry way too much risk. So, to combat the potential problems that we just talked about, we would buy an option to protect our call that we sell. So since we sold the $100 call for $3 in premium, so we've got $300 in premium right now, we've sold that $100 call, we're hoping the stock stays underneath of 100. We're going to go ahead and buy a call that is above that $100. So let's go ahead and say that we're going to buy the 105 call now. And we're going to actually buy this one. We're not going to sell it. And it's trading at $1.20. That means that we're going to pay $1.20 for this, which means that we are buying a call option to hedge the sell that we had just done. So since we've sold at 100, we now have hedged by buying at 105 that if the stock were to take off, we now have an option that can appreciate in value and it can completely eliminate risk for us. The reason that we buy this options were to go against, the reason that we buy this option is so that if the stock were to go against us and take off, we're able to limit our risk and the option that we bought will appreciate in value. The other great thing about this is that you know going into this trade exactly where your break-even points are going to be, exactly how much money you can possibly lose on this trade, how much money you can make on this trade, so you know everything up front. And you can also tailor these trades to, if you're only comfortable with losing maybe $100, then you can tailor your trade that you can only lose $100. Or let's say that you have more risk tolerance and you want to collect more premium, you could set up your trade to where you could lose $1,000, but you could collect more premium. So the spread is completely dependent on your risk tolerance. Typically, I like keeping things a little bit closer. I don't like risking more than about $300 per contract. So we're going to go ahead and we're going to move on to the next part, and we're going to figure out exactly what happens in these situations. So how can this option work? This is one of three ways that the option can work. The first scenario is the most basic, and it's what we're looking for. So the first scenario is going to say that ABC stays below 100. So going back to what I've just said, we sold that $100 call, so we want this stock to stay below 100, because if it stays underneath of 100, we collect that premium, both options expire worthless. So since these options expired worthless, we are going to collect the $300 premium for selling, and I'm sorry, this is a typo. This should say $100 here. So we're going to collect a $300 premium for selling the $100 call, not 45. The puts are trade at 300. However, we bought insurance on our option, so we're plus 300 on this trade as it stands, which is great. But since we don't want to be worried about undefined risk and infinite risk and all of these terrible things that could happen if the stock did take off, remember, we bought, and I'm sorry, it's harder to find your mouse in white than I gave it credit for originally. So we bought a $120 option that expired worthless, which means that we lost 120 on that end of the trade. Again, I can't stress to you enough, do not worry about losing on one side of the trade. You will win on one side of the trade and you will lose on one side of the trade. That's how these are going to work. However, we just want the stronger side that has more money to be the winning end. The other side is just strictly for our insurance. So since we wanted to insure this trade, we clear $180 in profit. And we've defined our risk. We've also kept risk completely out of this trade for the most part because we have been able to buy insurance. We've been able to define our risk, which is something that is very hard to do in the markets. So anytime that you can define your risk and you can find something that is right in your risk tolerance, that is a great, great, great thing for you to do. So our second scenario is, let's say the stock takes off and goes to $130. That means our option is now $30 in the money, which means that we lost $2,700 on this option. Let me explain to you how we lost $2,700. We were obligated to sell these shares at $100. The stock is now at $130. So since one contract equals 100 shares, 100 times 30 is $3,000. Now, we collected that premium, that $3 premium regardless. So that $300 premium does go towards that trade, which means that our loss on this option is $2,700. However, since we bought that insurance, we're really happy because now this option has moved $25 in the money, which means that we've collected $2,380 in profit. So that's going to bring our maximum loss to 320. So even though this trade worked against us, our maximum loss was 320, and our call option we bought protected us. In this trade, our maximum loss comes into play anytime the stock is over 105. So we will explain here after the next slide exactly how we find out maximum loss. However, since the difference between our premium and the call, that means that, let's say the stock were at 101.80, which happens to be the break-even point on this trade. The difference between 105 and 101.80 is $320, or $3.20 times 100, which equals one contract, which is $320 of maximum loss. So that takes us pretty much right into our next slide. How can this option work? 3 of 3. Let's say the stock stays between 100 and 105. That means our 105 call expires worthless, so we lose to 120 on that end of the trade. Now let's say the stock is trading at 101. The option that we sold will be worth 1, which means that we collected $200 of our $300 premium, and we lost 120 on our call, which gives us a gain of $80. Now, I do apologize. I believe that I got a little bit jumbled up in the previous section. So, to find our maximum loss, and I will show you something also on Thinkorswim's platform that is spectacular, but we find our break-even point, which is 101.80, and anytime that this trade goes over 101.80, that means that we're operating on a maximum loss, because the difference between 105 and 101.80 is $320, and that means that our maximum loss would be $320. It doesn't matter if this stock goes to $500, our maximum loss on this trade would be $320. So the great thing about trading these vertical options are that it gives us a way to have defined risk. we can write an option that, since we think a stock is going to stay above or below a certain price, we're able to try and capitalize off of that without having to use a lot of capital or without having to have a lot of risk. And that's why vertical options are such a strong part of trading. So, as I've said before, Thinkorswim's platform is, in my opinion, the best platform that there is out there. And I apologize if you can't see my screen. I've had some trouble with people being able to see the screen properly. But let me go ahead and show you how this works. So you can actually come here and let's go ahead and look at Marathon Oil. So let's say that we don't think that Marathon Oil is going to stay above, or that we don't think it's going above 30, or I'm sorry guys, that we don't think that Marathon Oil is going above $15 by June the 17th. What we can do is we can go ahead and right click on this option. I'm sorry. We're going to want to sell. And right up here we have the vertical option. So it'll actually set up your strategy right here. So we can set up how many of these that we want to trade. If it wants to be 6 contracts, 1 contract, and it shows us everything that we need to know right here. So we're going to receive an $11 credit for this trade, and right here I could change my call option if I wanted, if I was feeling a little bit riskier or not. But let's go ahead and look at this. If we were to look at this, where we have a $15 call that we're selling and a $15.50 call that we're buying for insurance, if I hit confirm and send, it's going to give me this little nifty screen that I'll bring towards the middle of the screen. Our maximum profit in this trade is $11, and our maximum loss in this trade would be $39. We can't lose any more than $39 in this option. And that is the power of Thinkorswim, because it will go ahead and it will give you everything that you need to know about this trade. If you look here, 1511 is our break-even point on this trade. So anytime this stock goes below or above 1511, it means that we are operating on maximum loss, which in this case would be $39. It also breaks everything down here, where we'd be given an $11 credit minus 3 equals a credit of $8. The buying power effect would be 0. Now let's say that we have a little bit higher risk tolerance. We come down here and we could switch this to, let's say, 1650. And as you can see, our maximum profit was able to move up a little bit, and our break-even price moved up a little bit. But also our maximum loss got stronger as well. So always keep in mind how much you're willing to lose, and for how much that you are willing to, I'm trying to figure out how to word this. How much are you willing to lose to bring in a certain amount of money? So are you willing to lose $300 to bring in $100? How confident are you in it? And there's many different strategies that we can go over to help us ensure that we have winning trades, and we will go over many different ways to do that as this segment continues. As for now, I think this video's about been 20 minutes long. I'm going to go ahead and let you guys absorb this and let you think it over. If you're just learning, I recommend getting a notebook and writing down as much information as you can, writing down the example, and that way if you're ever going to look back at things, you can just look in your notebook and it'll come right back to you. Again, if anybody has any questions, feel free to comment below. Please make sure to like and subscribe to our page, and feel free to message me or comment on YouTube as well. I thank you guys, and talk to you real soon.